You're watching Global Insight, where we speak to experts from around the world on issues making headlines. I'm Hanyang. The global economy is facing significant challenges as growth continues to slow while high inflation is rampant across countries. Energy supply shortages, interest rate increases and geopolitical conflicts certainly haven't helped. Today we take a look at where the global economy stands today and where it's headed in 2023. For this, we turn to South Korean economist Dr. Ji-yeol, Associate Professor and Head of Finance at Hanyang University. Very warm welcome to you, Professor. It's lovely to see you again.
Thank you. Pleasure to be in the programme, as always.
Right, well, my first question to you now, corporate profits in 2021, they were the highest in 70 years, apparently. And, well, real wages and labour's share of income, though, they have not been on the rise. So does raising interest rates by central banks, does it really work? Or does it just hurt small businesses and lower middle-income families?
Right. I think those are two separate but related questions. So we haven't seen inflation rising at this fast pace since early 1980s. So it's the first time in a generation that we're seeing this. And the central banks around the world had no other choice but to take measures and respond to such challenges. So we have seen evidence of inflation slowing down in the US. It peaked at year-on-year 9.1% in June, but by now the November figure is about 7.1%. We're expecting somewhere in the 6% region for December. So it has slowed down, but the sad reality of the things is that monetary policy is a rather blunt tool. So it doesn't affect everyone equally, and that, as you said, small businesses, households that were indebted, likely from COVID and related issues like layoffs, furloughs, they were the ones that were most affected by those rate increases and rising mortgage costs, rising interest payments. So while it has been a necessary measure, and it has worked to an extent, it is still, the cost has been borne out primarily by those small and medium enterprises that you were talking about earlier.
Right, and the persistence of inflation over the past year, although it has been slowing down slightly, as you mentioned, it's been rather alarming, and it was undeniably very problematic within the United States. But the pain has been even larger in other parts of the world, such as Europe. And, well, my question is, in what ways has the nature of the inflation been really different for the United States and Europe?
So I would say that it has been similar in one respect, but different in the other. So let me spell that out. The entire course of inflation of the past 18 months or so has been primarily supply-side driven. So COVID has been an unprecedented event affecting every corner of the world, and that led to all the shortages in those along the supply chain, and that has been affecting not just the US, but Europe, Asia, even here in Korea, everywhere. But the nature of the supply side problem has been slightly different. So in the US, one of the primary concerns have been the wage and the overheating labor market, maybe due to some fiscal stimuluses in the early part of the pandemic, or various stages of the reopening having differential effect. But it has been very difficult for businesses to get hold of workers. I mean, I was in Champaign last year, and the wages for FedEx and DHL type of workers were just going up and up month by month. So that has been the primary problem for the US, whereas I would say the bigger problem for Europe has been the energy front and the war in Ukraine. Now, that has affected every part of the world, not just Europe, but Europe has always been much more reliant on natural gas and oil coming in from Russia. So Germany, for example, were very much reliant on those Nord Stream linkages with Russia, and the rising energy cost from war in Ukraine, along with other shortages in the supply chain, have been the main driver of inflation in Europe. So when things are much more supply side entrenched, core fundamental related problems, like it's the case in Europe, it's more difficult for central banks to deal with those issues, and that's what we have seen. So in the US, we have seen inflation coming down a couple of percentage points over the past 3, 4, 5 months. We're not really seeing that in the Eurozone, and it's still very high. I think the November figure is 10.1% year on year. So Europe is likely to feel the pain probably for longer, unfortunately.
Professor, well, how have high interest rates affected the global business climate and overseas investment?
Right. So it's always difficult to tackle supply side driven cost push inflation because there's just trade off. Monetary policies at the end of the day are demand side measure. So if you try to bring down inflation, it's rather unavoidable that production and employment will suffer. And we're seeing the beginnings of that. I mean, in the US, the labor market is, for now, proving rather resilient. But businesses are finding it more difficult to source financing for their investments. And rising interest rate payments on their mortgages and other debt are causing households to cut back on various spending. We're seeing a lot of demand coming down for consumer durables like cars and other major electronic items. And that is likely to have a prolonged effect on these business going into 2023 and probably likely to remain for the next 18 to 24 months.
I see. And well, in that regard, what's been the impact on South Korea?
Right. So South Korea is quite different from other major advanced economies in that in response to COVID in many other parts of the world, it was the government that took on the debt through its fiscal stimulus. The US handed out this $2,000 checks to every household. We had that to an extent too, but the businesses, the small businesses that we were talking about at the beginning of the program, they were taking on the brunt of the pandemic-related policy measures through taking on more debt. So household debt and the small enterprise debt are at all-time high. And the interest rate hike could not have come at a worse time. And another thing that sets South Korea apart from other parts of the world is that our household asset, is very much driven by and reliant on housing market. So we're seeing 30-40% decreases in house prices along with the jeonse, the price. And that is likely to have a huge impact on consumption. And that's going to actually be rather problematic for the Bank of Korea as they try to keep up with the US. US is likely to raise its interest rate a little further, but South Korea the Bank of Korea rather, will face a very unpalatable choice between letting the exchange rate and won weaken further versus making those households that are already heavily indebted even more vulnerable from rising interest rate payments.
I see. So global conditions are unfortunately making livelihoods harder here in South Korea. But other challenges for the South Korean economy, though, are things like decoupling. As we continue to see the US and Chinese economies separate, as we see decoupling intensify, what challenges would that pose for global businesses?
Right. So what we saw from COVID and the war in Ukraine is that it's very difficult to rely on one source of production. So China's zero COVID policy over the past, they recently scrapped it, but for the past year or two, it has been cutting down factory at practically zero notice. Like, Apple's Foxconn factory in Zhengzhou just closed at like 30 minutes notice, for example. So production has suffered as a result. We have had our own trade disputes with Japan regarding the key core materials like photoresist and hydrogen fluoride, etc., for the semiconductor production. So we are seeing the global economy moving away slightly from one giantly linked supply chain to a more localized, more domesticated, if you like, version of supply chain where you are less reliant on one other country that can turn against you for many reasons.
And we're seeing countries like China and Russia try and move away from using the dollar. They want to use their own national currencies and transactions. And well, will de-dollarization work, do you think? I mean, and is it also reliable to use national currencies in the long run?
I would have to say a qualified no to that question, mainly because not because of the size of the economy. I mean, Russia, India, China, etc., combined, they command a formidable share of the global market now. But I think the bigger issue is that using a currency for international transaction requires more than just, economic growth. Financial development has to also come hand in hand together. And there, I think the emerging market has been lagging behind a lot. By that, I mean the lack of capital controls, opening up foreign exchange market where your currency can be freely traded 24 hours a day away from your own shores. Even Korea, for example, is quite reluctant to do that, mainly because of our experience with the East Asian financial crisis in the late 90s. So while China, Russia, etc., are teaming up with some countries in the Middle East and trying to use petro rubles, petro yuans, and it may work to an extent, whether they can replace dollar in the main medium of exchange and the international trade arena, I think that's going to be a much longer term issue. And I don't think the dollar status will be in threat in the foreseeable future.
Some other long-term issues, supply chains. Now, how do you think countries are going to aim to increase their supply chain resilience? And what are the biggest risks that they should really factor in?
Right. So what we have seen is all these geopolitical and all these black swan kind of events that affect the supply chain. And I think the ultimate issue here is how can you diversify? So it's not going to be that Apple is going to move entirely out of China next year. I mean, it's a big market, for example. So they're not going to do that. But what they will be willing to do is to open up new factories here, there, and everywhere. And other major like electronic companies, for example, Samsung as well, they will all be aiming to diversify away supply chains and also diversify the sources of key material supply as well, like the core materials needed for the production. So whether they can achieve this diversification in the near future or not will be dictating the pace at which they can strengthen and make their supply chain more resilient. And it's not going to happen overnight, but the direction will be much more clearer towards that direction for the foreseeable future.
I see. And finally, Professor, what move do you expect to see the US Federal Reserve take in its next FOMC policy meeting?
Right. So at the December meeting, Jerome Powell stated that the FFC's federal fund rate could go all the way up to 5.75%. But the market is not expecting as hawkish a stance. In fact, the FOMC's membership will change come January. And the Chicago Mercantile Exchange's Fed Watch tool is expecting they're almost about half and half between whether FOMC would pause the rate increase in February, that would be the 1st February, or whether they will go for the 25 basis point increase. My guess is that in trying to appear hawkish, the Federal Reserve will likely probably go for a 25 basis point increase in February and then look for things to come in March. But at the moment, I would say it's pretty much a coin toss as to whether there will be a rate increase pause or a 25 basis point increase, as far as the market is expecting.
Right, thank you. That was Ji-yeol, a South Korean economist and associate professor at Hanyang University. Thank you again so much for your time this morning.
Thank you very much.
Also, thank you very much to our viewers for tuning in. Global Insight will be back on Thursday, South Korea, at the same time, so do join us then. Have a great day wherever you are. Goodbye.